We want to go to our next
Please,
guest here, who predicts the relief package will contribute to the best economic growth in 5 decades. Joyce Chang is the chair of global research at JP Morgan. Joyce, great to speak with you.
Great to be here.
So the best growth in 5 decades, but has that been priced in with the markets sitting pretty much at record highs?
I don't think it's been priced in. I mean, we're looking at 9.5% growth for the second quarter of the year and north of 8% growth in the third quarter of the year. And we've also taken our forecasts higher on commodity prices as well. So I don't think it's fully priced in. I mean, this fiscal package is a victory for Biden. It happened a bit sooner than expected, and he really didn't have to make that many concessions. And when we look at actually what this means for earnings, it means that the multiples can be sustained here. When we run the numbers over here, we think that about every $1 trillion of stimulus adds about $4 to $5 to EPS. So I don't think that this is fully priced yet. We're very comfortable staying with 4,400 on the S&P 500 target.
Joyce, when you look at the overall market, the biggest fear in the market has been interest rates. So when you look at what you're thinking about going forward in the overall marketplace, are you nervous about inflation at all, or do you just think that it'll be absorbed within the market? The Fed waited years to create inflation. Finally, they had what they were trying to do. So this is all comes with a normal recovery?
Well, I mean, inflation is running higher than what we've seen in the decade. I mean, you're looking at this globally at around 4% and 3% for the next quarter. So the market fears on inflation are not going to go away. But I think the Fed messaging has been very clear. It's almost like they've been trying to outdove each other in the statements. They're prepared for this. They've warned the market about an overshoot. And from the point of view of the equity markets, what's driving rates higher is actually positive. It is the growth story. It's the recovery story that will be playing out in these middle quarters of the year.
It's Karen, let me just sort of hop on that point a little further. Even if the Fed doesn't move, the market can reflect that rates are going higher. And at what point does that start to push on the multiple, the PE multiple, even with greater earnings, that would dampen the market's return?
Well, I think with the lockdowns easing, you are going to see a change in spending patterns. And here we really do favor the consumer discretionaries, and we also favor certain sectors that have lagged. That includes the financials, and it includes energy. So you have to be more selective here, but a lot of this momentum trade was unwound, and you've already had a very big move in the rates markets right now, given the low point that we were starting from. So I do think a fair amount of this is already priced in. And remember that, in other parts of the world, we're not seeing the momentum that we are seeing in the U.S. It's U.S. exceptionalism. So we still have the demand for treasuries. We have the deposit growth and the demand for treasuries that's still very much in place. So, there could be moments when this is disorderly, and market structure, liquidity, what we saw, last week, there could be repeats of that. But we think that overall, this is something that can be managed, and that the Fed, has given the forward guidance very consistently on this and has changed the framework.
Just further on that point, though, Joyce, I mean, it's one thing to have the bond markets digest $1.9 trillion in stimulus, but you also think that an infrastructure bill could pass as well. So you add that spending to the mix, and could we actually see the bond market start going, higher than you think? It doesn't take the Fed to move the markets, obviously.
Well, I think infrastructure will be coming later in the year. It will also have to happen through budget reconciliation. So we're looking at a much smaller number, maybe something in the order of $300 billion, well below the Build Back Better, $2 trillion number that's been put out there. And I think some of that will get priced in as well. But, the key point that we would make is that, this will be, a second and third quarter story. We do still see that, by the fourth quarter of the year that you have growth coming down more to a quarterly rate that's around 3%. But it's these middle quarters when you have $1,400 of checks being sent, where some of the retail money is probably going to come back into the market. A little bit of a repeat of what we saw in December when you had the last checks sent.
All right, Joyce, pleasure speaking with you. Thank you so much.
Thank you for having me.
Joyce Chang of JP Morgan. Let's trade this and pick up right where Joyce left off in terms of the impact of the stimulus checks going into the stock market. Deutsche Bank did a recent survey of 430 retail investors, and on average, they anticipated putting 37% of the stimulus checks that they get into the markets. And so that could be anywhere from $25 billion of inflow if only people with online accounts deployed that money, up to $150 billion if every single person deployed the money to that degree. Tim, what's your take on what the impact could be this time around? We certainly saw it the first couple times.
Yeah, I think Joyce brings a great point, and you have a case here where think about some of the types of stocks and the momentum stocks that have been some of the recipients of this, secular stories, thematic stories, parts of that high multiple universe that have been under a lot of pressure of late. So I think that these are important dynamics. And then as much as people think that a Walmart or a Target were beneficiaries of COVID, a lot of those checks are going straight to those places. I mean, let's be clear, and that's where a lot of people do a lot of shopping, and where I think the focus of much of the stimulus is going. So I agree in revisiting some of those trades. I think you have a case where you're going to see follow through on big ticket purchases. I think auto sales continue to be something to watch as well. And the auto industry, despite chip shortages and whatnot, seems to be a place where investors are putting capital in addition to buying underlying cars.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.